Buenos dias. Good morning. I'm so excited to be here. My name is Elizabeth Yin. This is my first time to Peru. All right. So today I'm going to talk about investment learnings across 800 startup investments that I've made. So let's begin. So why should you talk with me? My whole life is all in on startups. I'm from Silicon Valley in the San Francisco Bay Area. And for most of my life, I've been a founder, actually. I've had many failed projects, many failed startups, many learnings. I've had one company, LaunchBit, which was acquired in 2014. And I've been an investor as an angel in over 100 companies. I previously ran the 500 Global Accelerator Program, where we invested in over 200 companies. And now I run a VC called Hustle Fund. We invest globally, and we've invested in about 500 companies across funds 1, 2, and 3. We also run an angel club with over 1,500 angel investors globally, including some here in Lima. So my whole life is about startups. Oops. Oh, whoops. So many learnings along the way, starting as a founder. In 2008, I decided to leave my cushy job at Google, right when some of you may remember the great economic recession was starting. So wonderful timing. I didn't know what I was doing at all, and so I couldn't raise any money, but that turned out to be a good thing. But during 2008 to 2010, I really learned a lot about how do you experiment as a founder? How do you find product market fit? Between 2010 and 2011, how do you iterate quickly, and how do you pivot? How do you make changes very rapidly and learn as you go along the way new skills to become a CEO of a bigger and bigger company? And then between 2012 and 2014, the lessons were more about management. How do you hire, which I was terrible at? How do you manage a team, which I was terrible at? How do you learn all of these management skills very quickly? And I think my learnings as a founder across all of these years is that actually, if you can do all of these things, you will find some level of success as a founder. It may not be a unicorn business, but you will be able to just keep moving one foot forward to build out a business and improve and iterate along the way. But that isn't the case as an investor. When I moved over to the investor side, it was very unclear how do you even own your own success? You are not in charge of the businesses you run. You may think of yourself as an investor in a company, and you could imagine yourself as the CEO, but you are not the CEO. You are not driving the startup. You are not operating the startup. You don't control anything in the startup. So how do you find success as an investor? And that was probably the biggest learning that I had in moving from entrepreneur to investor. You have no control over this business. So here are some 5 lessons learned. Of course, there were many others that I learned along the way in moving into the investor side. Actually, just for a quick show of hands, how many of you are founders? Great. And how many of you are investors? How many of you want to be investors? Okay, a good mix, a good mix. So there are 5 things that I learned from investing in over 800 companies. There are, of course, many other things that are important as well, but these are probably my top 5 takeaways in how you can start to have some level of success as an investor when you have zero control over what happens in a company. So the first lesson that I learned was around portfolio construction. Actually, portfolio construction can solve a lot of problems if you just create a good portfolio. You have no control over any one company, but if you have enough companies in your portfolio, that will give you some semblance of control over your entire portfolio. And in fact, I would even say that portfolio construction is even more important than picking. Obviously, you want to pick winners, but you never know who's going to be successful. And so the more shots on goal that you have, the less pressure you have for any one company to be successful. And so if you have a larger portfolio, it will be more forgiving if you make more mistakes. And certainly when I was first starting out as an investor, I made lots of mistakes. I think probably the first 40 to 50 investments I made were terrible. And even though some of your companies may go along to do very well and get to the late stages, even to this day, especially in this economy, companies fail left and right, even if they're at the later stages. So you just never know who will win, even at the later stages. So construction helps you mitigate that risk. I know there are plenty of people in the room who will take a debate on whether it's better to have a large portfolio or a small portfolio. And I think that I've seen success in both camps. They both can be right. But I think if you are starting out as an investor and you don't quite know what you're doing, a larger portfolio can help you learn because you will make a lot of mistakes. My second lesson learned is actually what kind of level of success do you need to make the portfolio work? And I think working backwards a little bit, the adage that I like to cite over and over is 9 out of 10 companies fail. And I actually think that is pretty true. It's not just a saying, it's pretty true. But what do I mean by that? It doesn't mean that actually 9 out of 10 companies go to zero. It means that you as an investor will not get that much money out 9 out of 10 times. And it could actually be even because one of your companies is successful but never exits. How do you get your money out? Oftentimes you can't. So what that means is the 1 out of 10 times that your companies are successful, they have to be really successful. They have to make up for all of the losses, and they have to also win on top of that. So let's talk a little bit about what that looks like. I think roughly speaking, it has to be about 100x. So what do I mean by that? If you invest in a company at 5 million post-money valuation, you're looking for an exit of $500 million or more. And in fact, you're going to be diluted down from subsequent fundraising rounds that a startup will have. And so you may be diluted down as much as 50% or more, depending on how many rounds are raised. And so in order to get to this 100x, that generally means that investing earlier at lower valuations tends to make that a little bit easier. And the thing that is really interesting about portfolio construction is that your downside risk is capped. It's just the money you invested. But your upside is uncapped. So your companies could exit for hundreds of millions of dollars, billions of dollars, or even tens of billions of dollars. And your level of success is actually based on how big that upside is in your 1 out of 10 winners. The third thing that I think is really important is deal flow. Now, that seems obvious. Every investor knows that you need deal flow. But I think the thing that people don't think about is repeatable deal flow, a repeatable customer acquisition process. What we ask our founders to do is to look for a repeatable customer acquisition process for their companies. What we should ask ourselves to do as an investor is to look for a repeatable customer acquisition process in our deal flow. And I don't think many investors think about it that way. And so, for example, when I look at a lot of fundraising decks of emerging fund managers, very often you see slides like a founder of, oh, this is my team, and these are my past successes, and this is what I've done before, and it all sounds good. But very, very few people talk about what is their go-to-market plan. How do you get repeatable deal flow over and over months, years, as an investor? So there are a number of strategies that work well, but a couple of investors come to mind who do this really well. There's the inbound strategy. 20 VC, some of you may listen to that podcast. SaaStr for B2B, some of you may be part of that community. And they just have a large audience of listeners or followers or newsletter subscribers who keep them top of mind all the time. And so when they think of, oh, who should I go to? When a founder thinks of, oh, who should I go to when building a B2B SaaS company, if you're on the list for SaaStr, SaaStr comes to mind pretty quickly. But inbound isn't the only way. I know VCs who do a lot of outbound. Untapped VC is an emerging fund manager, and they just send cold emails to founders they want to invest in. And so that could work as well. And there are also folks who specialize and are known for their specialization in fintech or in the assets that they have as a company. So I think every investor needs to think about what is their repeatable go-to-market strategy, and that's something that I think most investors don't think about really at all. The next lesson that I learned is around what I call hustle. Now, everybody has a different definition of what does hustle mean. For me, hustle means iterating with speed. So moving quickly, but being able to change directions quickly as well. So speed works both ways, as an investor and as a founder. You know, as a founder, iterating quickly was important because you might be doing one thing to quickly test whether your hypothesis is right. And then you might need to change direction to test something else, and then change direction again. And the faster that you can do that, the more shots on goal you have with your startup, with your limited runway. But the same works as an investor as well. For us, speed wins loyalty. We write checks very quickly. And in fact, in many cases, we will interview a founder just once and make a decision in 48 hours about whether we're investing or not. A lot of the global accelerator programs you may know of, Y Combinator or Techstars or 500, any of those, they generally do a quick interview in 20 to 30 minutes and make a decision pretty much the same day. So writing fast checks builds loyalty with founders, and people remember that. So I think speed is very important in the startup ecosystem. It says a lot about what kind of founder someone is, and it also says a lot about what kind of investor someone is in terms of their responsiveness. And that's something that I've noticed that founders really gravitate towards. They want investors who can keep up with them. Lastly, I think the last lesson that I would share with you is you need to know your strike zone. And actually, I think an investor who is really good at that, who is not even in the startup markets, you may have seen in the news that Charlie Munger passed away very, very recently, just I think today or yesterday. And I think that Berkshire Hathaway does their strike zone investing really well. And they're a firm that I really admire. They don't look to try to invest everywhere. They stay within the zone that they know. And I think that's really important as an investor for you, if you're an investor, to find your own strike zone. For us at Hustle Fund, our strike zone is generally these things you see on this slide: low valuations, teams that can learn and execute quickly, teams that are scrappy, that don't need a lot of capital, and keep their burn rate really low. Teams that are working on very different ideas that people think sound stupid or silly. This is our strike zone, but everybody's got a different strike zone. It may be a specialty that you know really well, or that you have connections in, or an industry that you used to be in. But I think that often investors try to chase shiny objects and try to chase things that they don't know or that are out of their strike zone, and because it sounds good. I think that this is one of the areas that was really hard for me in starting out as an investor to get disciplined about. There are things that sound good and probably are good investments that I now just pass on that are outside of my strike zone. And I think the reason it's important to stay in your strike zone is if you stay in your strike zone, it helps you learn more quickly about lessons learned in that strike zone. So you get better and better as an investor in your strike zone. Versus if you start investing outside of your strike zone, you don't have any edge, you don't have much knowledge, you don't have any real reason why you should be investing outside your strike zone because you don't have that built-in repeatable practice. So why should you even care about any of this? Like, all of this sounds kind of hard, and if it takes burning through 40 or 50 investments and 800 investments invested in and stuff like that, like, why would you even bother? I think the startup asset class is actually really great, and that's why I've thrown my whole life into this. Not only from a returns perspective, but also just in terms of helping to build the world. And I think here in Latin America, you have an amazing opportunity to do that. There are so many interesting tech-enabled opportunities just, looking around that are untapped. Unlike in places actually, like in the United States, where everything is pretty competitive, and I would say that a lot of the low-hanging fruit opportunities are gone. But I think if we hone in on just the numbers for a moment, what is also interesting is this time and place in the market. I think one of the reasons why startup opportunities are so interesting is that some things in other markets have changed. So many years ago, the public stock markets in the US were great. For example, if you had invested in Amazon in the 1990s, they IPO'd at a $300 million market cap. And I didn't look at what their market cap is today, but you could have made easily 100x if you had held onto that. You could make 100x in the public markets. That's pretty unheard of. This year, Instacart, which in the US is our grocery delivery, I guess you could say, business, IPO'd at a $10 billion market cap. This year, in a recession year. And it's unclear to me, maybe there is some upside there, but it would be very, very hard to get 100x on that. The public market multiples are a lot lower than they used to be in the 90s. And in part, it's because in the US, we introduced a lot more regulation. And maybe regulation is a good thing, but it also means that the opportunity to make money in the public markets, which people have previously done over and over again, are now gone. I think there are other interesting examples in the private markets. You don't even need to invest that much money. Years ago, I think it was the New York Times who published an article about who made money by investing into Uber in their seed round. And there were people who invested very small checks into Uber. In fact, if you had invested 5,000 US dollars into Uber in their seed round, and if you had sold in their IPO, you would have turned that into $25 million, which is pretty incredible. So you can just imagine that if you're investing very small checks into companies at the earliest stages, that upside potential is really high. And I think, the last thing I would touch on is, why do people even invest in the first place? A lot of times it's because they want to have a good life. They want to spend money. They want to give back. They want to donate a lot of money. They want to have money for retirement when they're old. And so for all of these reasons, a lot of the times people invest is for the long term, not for tomorrow, but for 30, 40 years from now. And so if you just kind of run some quick numbers around what the stock market, the public stock market, has previously returned historically, typically about 7 to 8%, depending on when, over the course of a decade. And if you were to say, all right, instead of pouring all of that money into the public stock markets, even if we just take a little bit of that, $1,000 here and there, and we put that into private startups at the earliest stages, your upside could be pretty tremendous, but your downside is you just lose that small amount of money. And so I think that there are a lot of shifts happening in markets today that actually make investing in startups now a good time to do so. All right, so the last thought that I would leave you with is, okay, great, now I'm sold. I'm going to invest a lot into startups. But how should I go about it? How do I get these reps without losing a lot of money? How do I go from angel to VC? And I would say that for me, I think the last bit is like anything else, it's practice, practice, practice. And I think in part, I call it getting a lot of reps, just like how you go to the gym and you lift weights over and over again, and you get stronger by doing that over and over again, every day in and day out. Or if you learn the violin or the piano or play a sport, you get lots of reps in, you do that over and over, every day. You get better every day. And I think one of the problems with investing historically is people might invest $10,000 one day, and then maybe 3 years later, $25,000 another day. That doesn't allow you to get enough reps to practice and get better. And so what I would encourage you to do, for those of you who are investors or are trying to become investors, I would encourage you to work on how do you get those reps? And that's something we think a lot about at Hustle Fund as well. How do we continue to get those reps? I've invested in 800 companies, but I want to keep on getting more reps and keep learning from more reps, more deals, more startups, documenting them, et cetera. And the way to do that, honestly, is just actually to, one, see a lot. So it goes back to deal flow, deal flow, deal flow. We see about 1,000 startups per month at Hustle Fund. And across my lifetime, I've seen probably about 30,000 startups. So how do you get to see more and more to learn from all of the things that you see? And then once you see a lot, how do you start to actually get exposed to what is happening in many businesses? It could be by writing even a check as low as $1,000 into each of these, just to even learn, just to see. And inevitably, that larger portfolio will work out well. But I think another way, without even spending your money, is maybe get involved with an accelerator or another VC firm, mentor companies, see a lot of companies, work with a lot of companies, understand what makes a good founder. I think one of the ways that you get to see what good looks like is by comparing a lot of startups. Every startup in isolation looks good, but when you have 100 startups that you see, you can then all of a sudden say, okay, this one's good, this one's okay, this one is not so good. And so by comparing startups, that's essentially what you're doing when you're getting a lot of reps. You get to compare what good looks like. You get to compare what everyone is doing. And then lastly, taking all of that, documenting it, learning, and iterating in your own practice. So I am so excited for all of you. Let's go invest in startups. Thank you.